$10,000 or $78,000. Same starting amount, same time period. The only difference? One simple decision about what to do with your dividends. Most investors are leaving 43% of their potential returns on the table, and they don't even know it. Here's what's crazy. The difference between taking your dividends as cash versus reinvesting them isn't just significant. It's the difference between a comfortable retirement and working until you're 70. I spent the last month analyzing 20 years of dividend reinvestment data. What I discovered will change how you think about passive income streams forever. The math is so powerful that even Einstein called compound interest the eighth wonder of the world. But here's what Einstein didn't have: today's dividend ETFs that make this strategy absolutely explosive. Now, what you're about to see isn't a guarantee of future returns. Markets fluctuate, dividends can be cut. But the mathematical principle I'm showing you has worked for over a century. Today, I'm revealing exactly how dividend reinvestment multiplies your wealth. The compound effect that turns modest investments into serious money. And 4 specific ETFs that are delivering this strategy right now, including one yielding over 11%. Let me show you what 20 years of reinvesting really looks like. Think about Harry, who started investing in dividend stocks back in 2004. He had $10,000. Nothing crazy. Not an inheritance or lottery winning. Just savings from his regular job. Harry had 2 choices. Take the dividend payments as cash every quarter, or reinvest them automatically back into more shares. Most people choose cash. They see that dividend payment hit their account and think, free money. They use it for bills, vacations, daily expenses. But Harry chose differently. Year 1, his dividends bought him a few extra shares. Not impressive. Year 5, those reinvested dividends were buying dozens of new shares. Year 10, hundreds. By year 20, the dividends from his reinvested dividends were generating more income than his original investment. This is the multiplication effect nobody talks about. Your dividends buy more shares. Those shares pay dividends. Those dividends buy more shares. The cycle accelerates exponentially. The S&P 500's total return over the last century? 40% came from reinvested dividends. Not capital appreciation, not growth. Pure compound dividend power. But here's where it gets interesting. Traditional dividend investing meant picking individual stocks, hoping companies maintain their payouts, watching for dividend cuts, managing dozens of positions. Today's dividend ETFs eliminate all that complexity while amplifying the returns. Let me show you the first one that's changing the game. DIVO, the Amplify CWP Enhanced Dividend Income ETF, is doing something different. Instead of just holding dividend stocks, it's actively enhancing income through covered call strategies. Current yield, 4.51%. That's already double what most savings accounts offer. But here's the kicker. It pays monthly, not quarterly. Monthly dividends mean faster compounding, more frequent reinvestment. The difference seems small initially but becomes massive over time. DIVO holds just 39 positions. Top holdings include Apple at 5.29%, Microsoft at 4.94%, Caterpillar at 5.47%. These aren't speculative plays. They're profit machines. The expense ratio is 0.56%. Higher than index funds, but you're paying for active wealth-building management that's delivered. $5 billion in assets under management tells you institutions are paying attention. The one-year return of 14.6% total return beats most actively managed funds. Harry could have started here. $10,000 in DIVO 20 years ago with reinvested dividends. Based on historical dividend growth patterns, he'd be looking at significant multiplication. But what if you could double that yield? That brings us to something even more powerful. JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, is generating yields that shouldn't be possible from quality stocks. 10.6% yield. Let that sink in. Every $10,000 invested generates over $1,000 in annual dividends. But it's not just about yield. JEPQ holds the Nasdaq's best companies: Nvidia, at 8.31%, Microsoft at 7.18%, Apple at 6.72%. These are the companies driving innovation. The strategy combines equity positions with options premiums. Selling covered calls on the NASDAQ generates extra income on top of dividends. It's investment portfolio engineering at its finest. Expense ratio, just 0.35%. Lower than DIVO despite the complexity. $30 billion in assets shows serious institutional confidence. The one-year total return? 17.78%. That's not just the dividend, that's appreciation plus income. Monthly payments again. Every month your reinvested dividends buy more shares. More shares generate more monthly income. The compound spiral accelerates. Harry adding JEPQ to his portfolio would transform the trajectory. But here's what most people miss. Consistency matters more than yield. Time for the revelation nobody expects. The magic moment in dividend reinvestment isn't year 5 or even year 10. It's year 15. That's when the crossover happens. Your annual dividends from reinvested shares exceed your original investment. You're essentially getting your entire initial investment back every year in passive income, but only if you pick funds that maintain and grow their dividends consistently. Which brings us to the most reliable performer. SCHD, the Schwab US Dividend Equity ETF, isn't sexy. It won't give you the highest yield. But it's done something remarkable. 13 consecutive years of dividend growth. Through the financial crisis, through COVID, through inflation spikes, SCHD kept raising its dividend. Current yield, 3.76%. Seems low compared to JEPQ. But the growth rate tells the real story. 10.87% 5-year dividend growth rate. Your income stream isn't just stable, it's accelerating. The dividend you receive 5 years from now will be significantly higher than today. Expense ratio, 0.06%. Basically free. You pay just $6 per year on a $10,000 investment for professional money management. $71 billion in assets. This is where serious long-term investors park their money. Holdings include AbbVie, Chevron, Home Depot, dividend aristocrats with decades of consistent payments. Harry's portfolio with SCHD as the foundation would weather any storm. The consistency compounds, the growth compounds. 20 years later, that 3.76% yield on cost could be over 10%. But there's a new player disrupting everything. SPYI, the NEO's S&P 500 high-income ETF, is achieving something that shouldn't be possible. 11.59% yield on S&P 500 exposure. You're getting the stability of the index with income that rivals junk bonds. How? Sophisticated option strategies that extract premiums from S&P volatility. Monthly dividends again. $5 billion in assets despite launching just recently. Institutions are moving in fast because they understand the opportunity. The expense ratio of 0.68% is worth it for this level of income generation. You're essentially getting paid nearly 1% per month to own the S&P 500. Top holdings mirror the index. Nvidia, Microsoft, Apple. You're not sacrificing quality for yield. You're enhancing the index returns through dividend growth strategies. Harry adding SPYI would supercharge his income. Combined with JEPQ, SCHD, and DIVO, he'd have yields ranging from 3 to 11%, all from quality holdings. Let's do the math nobody wants to show you. $10,000 initial investment. Average 8% yield across these 4 ETFs. Dividends reinvested monthly. Year 1. $800 in dividends buys more shares. Year 5. Annual dividends exceed $1,500. Year 10. Annual dividends approach $3,000. Year 15. The crossover. Annual dividends exceed $4,000. Year 20. Annual dividends could exceed your original $10,000 investment. Your $10,000 could become $78,000 or more, without adding another penny, just reinvesting what the investments pay you. The same $10,000 taking dividends as cash? Maybe $25,000 total value. The reinvestment difference is $53,000. That's a new car, a house down payment. years of retirement income. From one simple decision, reinvest instead of spend. But here's what really matters. Harry didn't need to be a stock picker, didn't need to time the market, didn't need special information. He just needed patience and the discipline to reinvest. The strategy works because time amplifies everything. Each reinvested dividend plants a seed. Those seeds grow into trees. Those trees drop more seeds. Eventually, you have a forest. Starting earlier matters more than starting bigger. A 25-year-old investing $5,000 with reinvestment beats a 40-year-old investing $20,000 without it. The tax efficiency of ETFs makes this even more powerful. Qualified dividends get preferential tax treatment. In tax-advantaged accounts, the compounding is completely uninterrupted. These 4 ETFs give you everything needed for a compound interest machine. DIVO for enhanced income with blue-chip stability. JEPQ for maximum yield from tech leaders. SCHD for reliable growth and aristocrat quality. SPYI for supercharged S&P 500 income. Blend them based on your risk tolerance. Conservative investors might weight toward SCHD. Aggressive income seekers toward JEPQ and SPYI. The diversification across strategies protects you. If covered calls underperform, dividend growth compensates. If growth slows, high yield cushions the impact. Financial planning isn't about finding the perfect investment. It's about building systems that work regardless of market conditions. Dividend reinvestment is that system. Harry's 20-year journey proves it. Not through speculation or trading, through patient reinvestment of dividends from quality funds. Your future self will thank you for starting this today. Set up automatic dividend reinvestment. Takes 5 minutes with any broker. Choose your ETF allocation. DIVO, JEPQ, SCHD, SPYI. Pick what matches your goals. Then do the hardest part. Absolutely nothing. Let time and mathematics build your wealth. Let compound interest work its 8th wonder. 20 years from now, you'll look at your account balance. You'll see that the choice between $10,000 and $78,000 wasn't really a choice at all. The only question is, will you be the person who took the dividends as cash? Or the one who reinvested them and changed their financial future forever? The math has spoken. The ETFs exist. The only variable left is your decision. Start reinvesting today. Your 20-year future depends on it.